Today we're starting a brand new series breaking down one of the most entertaining and most important Bitcoin conversations of the year. This sit down between real estate mogul Grant Cardone and Michael Saylor, the man who has bet his entire career, company, and legacy on Bitcoin. Now, the original interview runs long, over an hour, almost two, and it's packed with wisdom, tension, comedy, and some of Saylor's most powerful explanations of investing and technology. So, just like we did with the 5-part Saylor keynote breakdown, we're doing it to dissect this conversation into smaller, easier to digest episodes, pulling out the most valuable lessons so you can understand why Saylor thinks diversification is a mistake, why he says if you're all in, you win, and why he believes that the right technology changes everything. This first part is about faith in a good idea and why most people never build generational wealth. Let's roll the clip.
I didn't buy any of those.
Are you going to give advice to someone they should put 2 or 3 or 5% of their portfolio in? It's like, I think if you're going to do it, you should put in an amount of money that changes your life.
Yeah.
So, well, look, if you're diversifying and you find a brilliant idea, maybe you put 5 to 10% of your wealth in it because you want to stay diversified. But, Jeff Bezos didn't get rich by having 5% of his assets in Amazon and selling 95% of his Amazon stock as soon as he could, right? So Steve Jobs,
I think he had 2
Larry
stocks
Ellison, Mark Zuckerberg, Jeff Bezos, Elon Musk, Bernard Arnault, they don't get rich by selling 95% of their good ideas and keeping the last 5, or by selling 90%. So I just think when you find, if you're pitching someone a digital real estate fund,
yeah,
and if real estate's going to go up 7% a year and Bitcoin's going to go up 30% a year, then you don't want it to be 10% Bitcoin and 90% real estate. It's just a little bit better than everything else in the world. Why not put it half and half?
Yeah.
And then why don't you deliver 20% gains a year when the entire rest of the real estate industry gives you 7? Because if it's a bad idea, it ought to be 0 and 100% real estate.
Yeah.
And if it's a good idea, then you might as well go 50-50,
right?
Because that way you're giving someone juiced real estate 3 times as good as every other real estate investment in the world. I think if it doesn't work and you put 10% of your money into it and it doesn't work, then you just had a dog real estate fund and it failed, right?
Yeah.
So when you have an idea, you either think it's going to work and you might as well put in enough such that you win and everybody gets rich, or don't do it at all. I'm not a big fan of that. I'll give you one more example.
Yeah.
Rockefeller invents kerosene.
Yeah.
Kerosene is the most highly distilled form of crude oil. And it's jet fuel. It's rocket fuel, right? It's pure liquid energy. Okay, so a good idea is I build a rocket. I build a rocket ship, I build a jet engine, I build a jet airplane, or maybe I create gasoline or diesel and I give you a car or truck. Those are all good ideas. Henry Ford, Boeing, they did that. What's a conventional idea, a safe idea? I put a kerosene lamp in the back of my horse and buggy.
Right.
And I tell all my horse and buggy customers that now they can read a book while they're in the horse and buggy crossing the nation. Or I put a kerosene heater in the back of the buggy because my customers complain about it taking 30 days to go across the Rockies in a buggy, and so I heat them up. And my point is, you don't really want to be the dude that's 2% invested or 3% invested in the revolutionary idea. You want to create the rocket ship. And so in that case, I feel like either don't do it or do it in such a way that it's so much better than everything else in the world that everyone will sell everything else and buy your thing and everybody lives happily ever after. So that's my view.
Where do you think the diversification, who sold the diversification to America and to the world? The idea to go into, just send it over here, to an ETF or a mutual fund.
It's a classic thing. I think when you don't know the answer, when you have 100 choices and you genuinely don't know the answer, and you're in the business of selling a diversified fund, you pitch in diversification.
Right.
So I think partly the Vanguard 500, John Bogle, and then conventional finance people. But
that's $11 trillion sitting over there. It's done very well for them, but I don't know that it's done that well for the American
the world's full of hedge fund guys that created diversified portfolios, and their pitch was, no one decision we make is going to bankrupt you, so give us all your money.
Right.
But if you actually look at the results, they underperformed consistently. The king of diversification is just to buy the S&P index. But generally, I think that there's a distinction here between the financial statisticians that want you to give them your money. For them, diversification is a good pitch because, like, hey, you're a retail investor or you're busy, and I'm going to protect your money by investing you in 27 uncorrelated diversified assets, and I'm going to rebalance the portfolio every month. And I'm going to have 50 analysts that rebalance the portfolio, and I'm going to charge you 2% fee and 20% of the upside. And my my value added is consistent dynamic diversification. So that's what they're selling, and they want you to believe that you need them, and they charge you. When you charge 2 and 20, you're basically taking 40% of somebody's capital over the course of 10 years, right? So it's pretty expensive service. On the other hand, there's another view of the world, which is the engineer's view of the world. When you build an airplane, you've got the choice of building an airplane in copper, aluminum, or steel, or bronze, or bricks, or wood, and there's a right answer, aluminum, and everything else is the wrong answer. And if you build it in steel, it doesn't fly. And if you build it in clay, it doesn't work, right? You build it in copper, it's not working. So in engineering, there's a right answer for the plane. It was aluminum. For bridges, there's a right answer. It's like steel, right? When you're creating a window, there's a right answer, for how what kind of glass you use, and then there's a wrong answer. So engineers are used to asking the question, what's the right answer? How about you want to conduct electricity through a line, copper, or titanium, or you can pick 100 metals, but there's one metal that works better than the other metals. So if you're an engineer and there's a right answer, you don't diversify, you pick the solution, because otherwise you die. But when you don't know the answer, when you're not sure whether copper's going up or aluminum's going up or steel is going up or a bushel of corn is going up in price, and nor does your customer know the answer.
Pick them all.
Well, you can create a service, which is I'll just give you a diversified mix of all of them, and that justifies your business, and you charge a lot of money for it. But I think that diversification only makes sense when there is no right answer. It's like the joke example I use is, you're on a sinking ship and there's 10 lifeboats, and one of them, is watertight and the other have holes in the bottom of them. Find the one that's watertight, put the entire family in that one, and then you live, and pick the one that isn't watertight. You're going to die, right? You're not going to diversify across a bunch of imperfect components.
What you just heard is classic Saylor, blunt, precise, and willing to challenge every traditional belief in finance. Here's the deeper takeaway. Most people never get rich because they treat every idea like it's average. They sprinkle a little here, a little there. They diversify not because they're smart, but because they're uncertain. Saylor is saying something radically different. If you find one idea that is objectively better, one technology, one asset, one engine, then diversification becomes dilution. He compares it to engineering for a reason. You don't build an airplane out of 10 different metals just to hedge your bets. You find the right material, the one that actually works, and you go all in, because your life literally depends on it. That's the mindset shift most investors never make. If you want exceptional results, you have to be willing to make an exceptional decision. And whether you agree with Saylor or not, there's no denying this. Bitcoin is the first asset in history that combines perfect scarcity, global liquidity, digital portability, and unstoppable demand. In part 2, we're going to break down the moment Grant pushes him on real estate, ETFs, and traditional diversification. And Saylor absolutely flips the script on everything investors have been taught for decades. Make sure you subscribe, hit like, and follow the entire series, because if you think Bitcoin is just an investment trend, these next episodes will change the way you think forever.